Hello, I'm Tom Ferguson and welcome to The Fundamental Molecule. This show explores the intersection of water, technology, and entrepreneurship. Each week, I interview innovators, experts, entrepreneurs, and investors in the world of water, helping us understand where this trillion-dollar industry is headed. These are the stories of the people building the future of the world's most valuable and fundamental resource.
Disclaimer. Tom Ferguson is the managing partner of Baird Capital Ventures. All opinions expressed by Tom and podcast guests are solely their own opinions and do not reflect the opinions of Baird Capital Ventures. This podcast is for informational purposes only and should not be viewed as investment advice or relied upon as a basis for investment decisions.
When I started Baird Capital Ventures, I needed help. I needed help of all kinds. But one of the things I needed most as a first-time fund, first-time manager was credibility in the decision-making process. Alongside Ivy Nguyen, David Stanton agreed to become a member of our investment committee, and he put a crucial brick in the BIV credibility wall. And in this episode, you will see why. David is deeply experienced in startups, growth companies, and corporates, and he now runs Cleanwater1, hired by Baird Capital after they purchased UGSI in 2022. I have learned so much from David, from management tactics to market assessment, and I know you will too. Please enjoy my conversation with David Stanton. David, how lovely to see you. Thank you so much for being here.
It's a pleasure being here, Tom. Always happy to help BIV.
Oh, yes. And how? I feel like there are probably days where you sort of wonder how it is that you ended up helping us quite so much.
They're my best days. So they're my best days.
You're the best days. Yeah, exactly. When it's really fun. So, to get us started, you've covered a lot of ground within the water sector. You've been in it for multiple decades. You've held positions of vast responsibility. You've obviously had a couple of fascinating tilts at the entrepreneurial windmill, and in many senses are kind of back there. So I think a good place for us to start is for you to just walk us through your career in water today up to where you are, literally sitting at the moment.
Oddly, it's my fourth decade in the industry. I don't like saying that. It definitely ages me out of
it. Doesn't look it, David.
Opportunity, but I'm at the beginning of the fourth decade. I'll just leave it at that. As I kind of reflect on my career, it really has been driven by what I would call the macro trends of the decade or so that were affecting the industry. And everything is sort of driven by what those trends were. I started in 1990 in a startup company, and we grew it up. It was very successful, but we got acquired in 1994 and then thrown on a team where we bought 28 companies and then sold them to US Filter. And then I joined a team where we bought 19 companies. The 90s was all about consolidation. And it was really the mega trend of the 90s. And I just got wrapped up in that. I was a general manager, started in sales, but kind of worked my way into that general manager role, but then became very proficient at the M&A process, which kind of led me from salesman with an entrepreneurial company all the way to CFO of Earth Tech when around 2002 timeframe came. So a lot of responsibilities kind of grew through that mess of consolidation. And that consolidation was driven by, some financial terms that were really good at the time to allow for consolidation, but also by the fact that we aged out all the founders of our industry. You can kind of date our industry back in the US to the Clean Water Act in 1972. And in that next 10 years, there were tons of startups focused on solving for water under the new Clean Water Act that was formed. And by the time you got to the 90s, those people all were retiring and wanting to sell their businesses. And I would say, that was really a mega trend that was supported by the just weird timing of the foundation of our industry and the aging out of a population. The average age of someone running a company in 1990 was in their 70s, probably. 10, 12 years later, they'd all been sold and bought and merged and retired. So, it really was an interesting time to start.
I didn't realize that. Anyway, you sort of immediately brain jumps to what is coming next. Yeah, so we got yourself to there, yeah.
Then all of a sudden, the Enron, the WorldCom, I was owned by Earth Tech at the time. We were owned by Tyco. It had its own version of its collapse. And the world stopped. We couldn't do M&A anymore. All of a sudden, we had to shift the whole industry to compliance. Compliance all of a sudden became really important. And operational, just running these businesses that we created all of a sudden mattered. You couldn't just buy your way into success. You had to actually start running these things. So I would say the next decade, I was at Earth Tech and then a company called Southwest Water. We really actually just scrubbed those companies down, wrote off bad businesses, doubled down on investment in good ones, cleaned up our balance sheet, got Sarbanes-Oxley implemented across the board. It was really a time of focus on operational excellence and compliance. And that really also translated at the utility level to a time where everybody realized that the revenue coming into the industry through water rates was not adequate to cover the cost of water. And if you went to any meeting or conference in that time period, all we talked about was the fully costing water. It was the number one topic because the average regulated water utility probably was earning, 6% or something in 2000. And today, they're earning their full rate of return. So it really started the trend to getting water rates right, which kind of sets up the next decade,
Yes, exactly. And I really hate to do this, but I think it's a really important one for a lot of people who are new to this. Could you just very briefly explain to us how water utilities are allowed to make money?
Yeah. So a water utility basically has to bill consumers. We are all customers. Everybody you talk to, you walk down the street, everybody you see is customer of a water or a wastewater utility. So all of the revenue in the industry comes from that. Of course, we have an industrial water component to our industry, which is very interesting, but the numbers are dominated by the municipal water sector, which is driven by water rates. And so a utility basically takes its cost of operation plus its cost of financing and divides it by the anticipated number of gallons that people are going to buy from it. And that comes into a rate. It's that simple. There are only two components that go in: O&M cost and finance costs. Doesn't matter if you're a municipality or an investor-owned utility. That's it. You add those together and divide it by anticipated consumption, and you get a rate, and you bill people for it. And so, so rates are really, really important to the understanding. And then also realizing that the customer in our industry really isn't the intermediary you're selling to. It's not the contractor or the engineering firm or even the city. The real customers are the people paying the rates. In fact, I like to use the word customer for a ratepayer and client for anybody in between. So most of my business sells to clients. We don't actually sell to ratepayers.
Names matter. Sorry to take you off. That came in way earlier than I expected, and it's really important, and basically no one understands it.
Good, because, it kind of sets up what the next big trend was. So after focusing on operations, I actually went back to my startup roots for a few years. It was a success followed by an immediate failure, to be honest. It was one of those that ramped up fast and collapsed quick. It was fun, and then landed running at one of the largest utility groups in the country for Suez. And that next period from about 2012 to even still going on today a little bit was really dominated by the digital transformation of how we run utilities. And it's also when we really started to see water rates start to catch up with costs. And they're both really important dynamics because the digital transformation is setting up a productivity gain in the utilities that's just going to be phenomenal as it continues to take roots. And at the same time, we politically and through, a lot of good work done over the decades are getting consumers used to the fact that their water and wastewater bills need to be higher and they're willing to pay. So if you look back from 2012 to 2021 or something, we have a lot of good data. Utility, water, wastewater utility bills outpace electric, gas in terms of growth. I think they average close to 5%. I think if you look at most major municipal regions that, you would see numbers more like 7% compounded growth on rates, in that period of time. And so, so this digital transformation is taking hold. If you look at where we were in 2012, just getting a smart meter was a hard sell. You couldn't even get a meter replaced that had technology attached to it. Today, it's the norm. There are almost everybody putting in very advanced meter technology. And anyway, it's great. So we're in this digital transformation and we're getting rates, which really, it's kind of comes to where we are today. And all that time I ran Suez, and all we focused on was transforming operations through this. So it kind of sets us up for where I think we are today. We are at a moment today where the industry is realizing massive productivity gains from, already and probably for another 10 years through the aging out of the older workforce and the implementation of new and better digital tools to execute the business around. And then we're also coming into a decade for the first time in my career where we actually have water rates covering the cost of water for the most part. So the ability to finance a project is relatively in hand now, where in the past it was always a struggle. And so, I think it's just a great tale. And I'm speaking mostly for the US market here today. And it's really been my focus for the last 10 years. So that's kind of my thought is, so after running Suez for so long and looking at, what's next, my company now is very focused on given the fact that we have room to make improvements and there's lots of productivity opportunities still to gain, how do we help utilities get that done? So we're just helping them. What are the technologies and solutions that drive basic, better performance for the utility? So I'm very focused on basic things. I'm not focused. I'm focused with BIV on like advanced technology and, all this really smart stuff. But in my company, it's very much, hey, if you can't manage your chlorine residual right, you're possibly introducing bacteria into your networks, which is the number one worst thing that could happen to utilities, way worse than PFAS or, 1,4-dioxane or anything else you've heard about in the media. So let's just make sure everybody's doing that right, and that's a huge market because they get about a D+ on that particular issue if you measure the whole industry. So we want to really push that out. So we're having fun. But I do think it's a good decade for what we do.
I certainly hope so. And I think it's really interesting to think about it. I wasn't expecting you to put it in the context of kind of overall macro trends. There are a couple of things that came out of what you said that I'd love you to reflect on for a second. So you've had considerable entrepreneurial experience of slightly unusual stripes, but you mentioned that you started as a salesperson. You spent some time on the CFO side as well. When you look back at the entrepreneurial experiences in particular, what do you think were the key things you learned? And what about the sales and in particular the financial management side do you think has been particularly helpful?
I've done 2 what I call startup. See where, I was in the startup, leading it and driving the business. And then, I've been on the board of 2 startups for a while. So a lot of good kind of vicarious experience through that. And of course, then I've helped you, Tom, at Imagine H2O and then BIV, so I've got a lot of exposure to.
Can't get rid of me.
Exactly. So first of all, the most important experience of all is sales. I'm not saying that every CEO has to be a great salesperson, but it is what I see most startups not paying enough attention to. The sales cycle, the path to market, the fragmentation at the bottom of our industry, which makes it very hard to access the industry at scale. These are impediments that are larger than any technology impediment or any other great idea. It really becomes for most businesses, the issue isn't, does my product work and is it good? It's how do I sell it at scale in a market that's so fragmented and disenfranchised? And, it really is an issue. So I would say, the number one experience is sales. What people get distracted by the most is financial. Because, you're in a startup, you got to raise capital, you got to meet with all these smart venture capital people. They seem like they're the center of the universe for a while. You feel important when you're doing it. And, your ego gets pumped all the time. And then, you get disappointments and, it's very easy to get distracted by all that. But nobody in the financial community buys anything that we do. And at the end of the day, that's all that matters. If you have the orders, you'll be able to get the financials. If you don't have the orders, it doesn't matter how many VCs you meet with, So, and then the operating piece, of course, the way I sort of look at doing this is, you're building your team. And I really emphasize team. This is really the first responsibility, is getting a team that can cover all these bases so that you don't have to as an entrepreneur. The more you try to do yourself, the more likely you're going to fail. So you have to build a team around you that does what you don't do well. It's very important to be aware of what your weaknesses are. So if you're not good at finance, just hire a good financial person.
Yeah.
If you're not good at raising money, let somebody else do it. If you're not good at sales, get the best salesperson. If you're a technical person, then be the best engineer in the company, but don't try to be the best engineer and the best salesperson. So really build the team around your strength, but really be aware of your weakness so that you have a team. The other thing I say a lot to entrepreneurs is you need water people, particularly on your board. The path and the route and the cycle, the wavelength of our industry, it does not match other industries. And water people get it intuitively. We've been in it long enough, we know. But if you have a lot of non-water people, they always think they're going to disrupt us. You can, if you've got a 20-year horizon. We're very disruptive, to be honest. Because as I went decades, that was all disruption, but it took 10 plus years for every one of those disruptions to really take hold.
It's really interesting. The other question that jumped out of what you said was, how does one do M&A well?
Looking back over time, this is one of those where I usually answer that 80% of what I know is what not to do. So
which is definitely the most important thing.
Because, if I was involved in 30 or 40 acquisitions over the course of my career, 80% of them were not successful. In fact, one time at EarthTech, when I was CFO, we had bought 19 companies. And I said, what if the goal was just to maintain the revenue of the last year we bought the company? We didn't have any growth plan, no synergy, nothing. Just What if we just stacked up the last year of revenue of every acquisition? And that added up like $2.3 billion. And I think our revenue at the time was $1.6 billion. So through the course of acquiring all those companies, we actually did not maintain the first year revenues of all the deals. It was a mess. We created a good company and it was powerful, but it was not what I would consider the type of success you would expect from M&A.
Yeah, it's unbelievably difficult discipline. I mean, one of the most surprising statistics to me still is that 80% of, and you just used the same number, that 80% of acquisitions fail to yield the value what's on the spreadsheet. And I really love that idea of, okay, hang on a second. What happens if we just don't break anything?
Yeah, exactly.
What does that look like?
Don't break it,
Yeah.
It's amazing how often that rule gets broken, which is kind of ironic. I'm in the market now. We're doing some M&A work. My view is start with your relationship with the business. You have to have a relationship. Like if I'm CEO, I want to have a relationship with the CEO of the company we're buying. I want to spend a lot of time with them before we even talk about money and dollars and cents. Do we like each other? Do our people like each other? Is there a fit that makes sense? Can we do a few projects together maybe, or co-work on something? Let's dip our toe in the cultural water before we kind of just dive in on a bid and buy somebody at the highest price. And you have to do all the due diligence at arm's length. And then all of a sudden you own this company. So most of what I'm doing now is just networking, building those rapport. And I'd like by the time the deal gets done, it's like we've been dating for a while. It's like getting married after you've lived together for,
yeah.
You're already sharing toothpaste and stuff.
Not much changes. Exactly.
Yeah, exactly.
The clothes are still on the floor and
Right.
That's so interesting. And if you flip it then, you've been a part of an acquired company before as well. If you're sort of speaking directly to the entrepreneurs out there who are, either thinking about positioning themselves for M&A, or maybe it's kind of 5, 7, maybe even 10 years out, how would you be thinking about it to give themselves the best chance of success?
The first is build those bridges now. You don't build the bridges with the idea that company's going to buy you. Build it because it makes good business sense to have the relationships in place prior to the moment where you're going to have the ask. And, that takes some time and some networking. And again, if you're CEO, you're not the best person to do that. Maybe your salesperson, or maybe someone on your board could do that for you. You know what I mean? And I think some of the value I think Burnt Island brings to some entrepreneurs, quite frankly, is that network ability to get that going, at an early stage with the companies, the relationships we have across the industry. But I think, start soon with the 3 or 4 potential most synergistic ideas and start building those networks early, because if you wait till auction day, it's not going to be necessarily good. The other thing which kills ideas, the number one killer of good ideas is valuation. If you sell your business at a stupid valuation, that's what killed my startup in 2012. We did our Series C round at a very high valuation. I knew it was high, but our sponsor VC was a promoter and they got a great valuation on our Series C. So it's great if you were in early like me, but it was terrible if you were the Series C lead investor, because they really were at a completely different. So all of a sudden your board goes from being very collegial and all together to you have these new board members that are in, oh my God, you need to like quadruple your business for me to even get out of this thing. You know what I mean? So it created immediate fracture on the board. The same is true when you sell to a strategic or anything. If you sell too high, it will force the first year or two of the business plan to miss its mark. And then the acquirer will be forced to restructure, to rebuild it, to do something dramatic to recover it. Be realistic about valuation. If you're in for the long haul, everything doesn't need to be a home run. Take a few singles along the way, keep some money in the game, get a second bite at the apple. Private equity is great for this. They love that. If you need money and strategic is going to just hire you and fire you, maybe private equity is a better route, so think about that in terms of not completely liquidating your position, but bringing in PE, taking a little bit off the table, getting a second bite through the next round of growth. Be really smart about the sustainability of your idea through the valuation and the process, and not just think you're going to make a one-off killing.
It never ceases to surprise me the degree to which there are very, very, very few free lunches. Eventually, whatever advantage you appear to have got, the bill is going to come due if you try to sort of get out over your skis in some way, because time is long.
That's right.
It's very interesting. So, you mentioned private equity. Obviously, UGSI, bought from Riverwood Capital Management by Baird. You are now running what was UGSI, now Cleanwater. How do you reflect on the overall private equity? What do you think that people within particularly the entrepreneurial realm, Often sort of PE is just looked at as this, yeah, great, we'll just sell to PE. And that's where the thinking stops. What do you think people should know about the incentive structures, the pattern of management, the way in which these companies sort of have to be run in terms of the intersection with the entrepreneurial world?
If you're CEO or the leadership team of a good, well-run startup that's growing and things are going on, what you want to figure out is, how do I sustain the growth opportunity here through the best available sources of capital that the industry has available to it? Your source of financing is not an end, it's a means. The mistake I see often making is people get kind of thinking that, again, the customer all of a sudden is the financial industry. It is not. Our job as the leadership team, to be quite blunt, is to take advantage of the best path through the financial industry to meet the end or means that we're trying to achieve. And what private equity is offering the industry today, I think, is new. It wasn't there 10 years ago or 20 years ago. And it's an opportunity to really realize what private equity is and how it works. Private equity is not like one company or a monolith, probably 3 or 4 tiers of private equity that are available to you as an entrepreneur. The lower tier, which we'll call maybe the C tier, likes to do small deals. They like to roll up a couple things together. They like regional plays. You can go to a C-level private equity and fund your growth from maybe less than $1 million of EBITDA or 2 million up to like $5 million of EBITDA with your strategy. And they'll have all the capital available you need to do it. Now, when you get up to a certain point, they're going to say, no mas. This is when we sell you up to a B-level private equity. And then the B-level, so say you've got a regional play and you want to go kind of super regional, that's successful. And now you want to go, okay, I want to go cover half the country with my plan. Now I need more capital to get that done. So you go to this B-level PE firm that then gives you the resources to get the whole. Then you outgrow them and you go to the A level, which says we're going to go, national or international. And they're going to take you to that next level. So there is a ladder of potential that the private equity world has available to us in the water sector, that it's our job as leadership teams to analyze that and figure out how to optimize our strategy through that financial path, if it makes sense. And the best CEOs that do it actually take all 4 steps. They get their seed round out of VC. They move on to that C-level or growth fund capital. They spend a little time there. They sell up to the next round, take a little money off the table, keep some money in, they grow up to the next round. They've been through 3 or 4 of these financial transactions. These are the CEOs and teams I respect the most. The ones that just come in, buy a company, crank it out for 2 years and sell it and move on. I mean, whatever. They're hired guns that don't really love our industry. You know what I mean? But they're important maybe, but really, I would say that understanding the PE world's really important right now, because it's, I think, the best source of capital for a young, growing VC-backed company.
Structurally, it really is interesting when we look across, especially at the software companies, but frankly, the hardware companies as well. They exhibit all of the characteristics that would be quite attractive to people who are trying to put a debt layer, even as that debt has got relatively less affordable than the entirely anomalous prior decade, I guess. We'll see how anomalous it is. But the structure of these companies, I mean, it's really heartening, I think, to realize or to see other people noticing what I think we've known for a while, which is that if you want predictable revenues and actually really good net revenue retention and being able to build within a customer base and all of this and very low churn, these are characteristics that private equity would like very much. And it's been, interesting to see them move. Just to change us a little bit. So it was UGSI. It's now Cleanwater1. You also had a really interesting...
We own both, by the way. We own both names, but we use Cleanwater1.
Cleanwater1. My apologies. I misread my handwriting on the... which is not the first time that's happened. I make doctors look like kind of Shakespeare. Anyway, but Cleanwater1, you also named the difference between customers and clients. And it's clear that actually what you call things is important to you. How did you think about the change of the name? Why is it important? Why is it important that we are really clear about the nomenclature we use for the various actors in our businesses? Maybe start with the change of the name and the kind of the branding element of it, and then maybe expand.
To make it very clear, the name of the company doesn't matter at all. That's why it's Cleanwater1. We wanted it to be Clean Water Solutions, but that was too generic and you get swimming pool companies. We then were going to buy cleanwater.com. It was for sale for like $1 million. Believe it or not, someone out there could go buy it if they want, but someone's holding it for a lot of money. And then we said, well, if we put a number 1 after it, we could buy it for $60. and then we even bought Cleanwater1 just in case we want to focus on wastewater a little more. But the idea is
That's great.
the idea is pretty simple. We need a corporate name that's simple, makes sense, tells people what industry we're in. Now, the brand that we acquired, UGSI Solutions, was actually also acquired by AE John, is being used to market products in the piping industry. So there's confusion around that. Also, one of our sales partners, which used to be Suez Advanced Solutions, has been spun out to private equity, and it's now UGS Solutions. We were US. So there were just too much.
Get out of whatever that was.
Yeah. So Cleanwater1, and really our goal is as we have a bunch of brands that are really well known in the industry. I mean, and our strategy is to continue to acquire proven brands that solve real problems that are not well implemented in the industry. And so you'll see us through M&A just buying stuff everybody knows. These are well specified. The engineers know them. But when you go out to the utilities, they're not well used. They need to be deployed better. And there's an opportunity to upgrade and replace all over the place. So our thought was focus on the brands. If you pay money for a brand, don't destroy it on day one by giving it a new name. So Cleanwater1 is just our holding company name. It's the umbrella that's going to host all our brands, and we'll have multiple brand names underneath of it that, hopefully our customers identify with the solutions that we're providing.
Okay. And then going to the second part of the question, the customer versus the client. I find this arises most, and I was actually talking to someone about this yesterday, is when there is a confusion actually who your customer is. There's often a dislocation between who uses your products and who gives you money. And we are absolutely adamant always that it's the person that gives you money that is the customer versus the one that isn't. And it's often kind of lost within the startup story. They think that the user is obviously important, but there's often that bifurcation. How do you think about that issue and making sure that everybody's using the right names for the right people? I can't imagine it's super confusing within the Cleanwater team, given what you guys are doing. But are there any reflections on kind of that side of things, of people using the wrong word for the wrong thing?
I think in your strategy and as you look at how you're going to make money, I mean, the most important thing you do before your strategy is just what's our business model? How are we going to make money? Once you kind of know that, then you develop a strategy and then a bunch of tactics. And so I think having the right words, that meet these things is pretty important, but it doesn't have to be generic or the same. But really the idea that when you talk to a utility, water or wastewater, somewhere in that decision-making organization, everything comes down to how does this impact rates? How does it impact compliance and reliability and safety? These are the priorities of the institution that you're selling to, whether it's a municipal, county, state, or an investor-owned utility. This is what matters the most to them. And the reason those are the things that are important to them is because that's what their customer only cares about. Being able to translate, but now you're selling to the utility. So yeah, they're technically your client or your customer. You're not selling to the consumer.
No, exactly.
But being able to translate your product or your solution into, how it impacts their customer is really important. I mean, it's really just very, very fundamental to understand that. And you have to spend time with the utility to get to that. I mean, it's not always obvious. So I would say just being really aware that that's the butter that's being spread on all our bread. Then now taking a step back, a lot of what we see, and my company included, we sell to the utility, which means, they'll hire a consulting engineer, they'll hire a contractor. There might even be an O&M operator and the utility. We sort of lay out that you have to sell everything 4 times at least, because you got to get that whole stakeholder world, completely aligned in order to make money in our business. And so, you're selling to all those stakeholders, but ultimately that customer, you need to translate it into the customer impacts. And if you're not making a customer impact, at some point, that's the main pain point of every utility. And if you're talking to industry, it's the same, except it's their product, right? Like if you're selling a water plant to Coca-Cola, how does this impact their Dasani water or their Coca-Cola can? You know what I mean? I mean, you very easily get to their consumer as well if you really focus on always thinking of the end user as the customer.
I love that framing of what really matters to the customer and keeping it simple. I'm just giving you mentioned them, the kind of interesting gatekeepers that I think are often kind of misunderstood from outside the industry. Can you just talk a little bit about the role of consulting engineers and how you see that potentially changing in the years to come, if at all?
Interestingly, the consulting engineers have been consolidating and growing like everyone else. So we used to have thousands of small regional firms. Now we have a handful of really big ones, but oddly, we still have thousands of small regional engineering firms. That seems to consolidate it, proliferates it.
This is an amazing, very technical hydra.
Yeah, exactly. The data is actually quite real on that, even though Jacobs and AECOM and WSG now are massive in our sector. The actual number of firms hasn't really declined because there's all these little spinoffs and things that start. But at any rate, their role has grown over the years. I mean, we always think that there's a way to get around the consulting engineer and to circumvent them or to short circuit that step because it tends to be a bit of a painful step. And you sort of disaggregate the technical decision from the emotion and the sale and these types of things. So they're not going away. In fact, I would suggest your best strategy is to make sure you have a strategy to win over that community. And you want them as your supporter and or neutral, that they would look at your solution and look at another one and say they're at least equal. But preferably you want them to say, our approach is better than the next, and they would choose it. They're always on their client's side, not your side, so they're really your friend. They know who their client is, and they're always looking out for their client's interest, not yours. But you can still have long-term relationships with them and influence their solution sets that they're driving to their customers. Very important part of the industry.
It's such an important part of it. I was just reflecting on the observation about management consultants, where there has never been a management consultancy done where the recommendation isn't more management consultancy. the progress of the business is sort of required for that to be the case. I think when thinking about consulting engineers, it's such an interesting thing is because the last thing often is what makes it challenging is that the thing that's going to guarantee them not getting the business of that customer anymore is for something to go wrong. And what's the best way? Apparently, I mean, it would stand to reason. I think it's a much better way of making things go right. But things are more likely to go wrong with things that aren't tried and tested and taken off the shelf. So you get this combined sort of incentive structure of like, we've done it before, it works. This means that we're likely to do the next sort of wastewater treatment plant for the city of San Francisco or whatever it is, in combination with the incentive structure of, we've done this before, we can do this at the lowest case, we can write the response to the RFP really fast and at low cost, and all the rest of the internal economics. So you've got both of these things acting in concert for a really quite a powerful outcome. Is that a fair reflection?
Yeah, I mean, go back to kind of what we were talking about earlier, where the main objective of the utility is what's the impact on rates? Am I in compliance? And is this improving reliability and safety for my consumers? And that all you're seeing is a reflection of that priority in the behavior of the engineering community. If you're telling me to use a new technology that brings risk to reliability or safety or increased cost, it's just a non-starter. The impetus isn't on the engineering firm. It's on the company or the entrepreneur or the startup to de-risk the implementation, to prove out reliability, and to come in at a cost point that makes sense for a rate-driven decision. And so it's very simple. I mean, I just see people getting hung up and blaming the wrong people. But at the end of the day, these are pretty straightforward hurdles and they're not moving.
Exactly. See the world as it is, not how you'd like it to be.
That's right. And if you can solve for that, the community is very welcoming to innovation and ideas and solutions. It really is. And frankly, it's improved quite a bit over the last decade or so as well. The willingness, particularly with digital solutions. We've de-risked the digital transformation a lot. So there's a much more openness to sharing data, to using data to change operating practices. And this type of resistance has broken down dramatically.
That's really interesting. I mean, you reflected a bit on how the sector's changed, certainly from situating it from the kind of the macro perspective. I just wonder if you can just go a little bit deeper on how it's changed recently and where you see it going over time. I mean, you've mentioned the digital side of things. It would be great to go a bit deeper on that, the determinants of why it is that, because data's been promised I remember we got all kind of excited about this kind of 6 or 7 years ago, and it hasn't sort of really manifested in the way that we were necessarily expecting, but things might be changing. I also wonder whether there are any other observations about where it might go next once we solve the data question. What do you think is coming kind of down the pipe? What are you trying to solve for at Cleanwater?
Well, for us, a couple themes that make a lot of sense today, and we're kind of looking on where to go. The first is our ability to measure and monitor what's really happening is growing, exponentially. The cost of putting monitoring and sensoring out is coming down. The quality of those instrument and devices are improving, and our ability to take that data aggregate it and come up with very basic operating improvements to feed back to the operations of the utility. That's all happening real time right now. And that's a lot of what we deliver. So our goal with, one of our product lines is, maintaining a good constant residual throughout your water. It's a very simple objective. It's actually a regulation.
Yes, which helps.
But the fact is, if you monitor 10 points once a month, you really have no idea what's happening with your residual out there. But if you put 100 or 200 online chlorine monitoring and pH and some other factors, you really know what's going on with water quality. And now you have to take all that and give it back to the utility as a solution on how to solve for that. They don't just want data, they want the actual solution that it points you to. So I mean, I could spend 10 years just working with utilities on that topic, and we never run out of opportunity to do work.
And you do absolutely fine. Yeah, exactly. So you've got this base of things that won't change.
Yeah, but that's being driven by the ability to measure and by the ability to crunch and process a lot of data quickly and feed it back to operations in a way that's meaningful and useful. So that's really happening. I mean, we're in real time now. That's not the future. And so, it's those types of things that will drive. And the net result, by the way, is improved water quality, better management of your chemistry, actually lowers the cost of operations. Because before this, if you had a low spot, all you did was dump more chemistry in at the plant. So you were over treating at the plant, which was creating, all sorts of other problems downstream other than your residual problem. And so, so the old way is being replaced by a new way, which is better cost point, more productive, and actually presents lower quality water. And then at the same time, we couple with getting gas chlorine out of the networks and out of the plant. We have solutions for that, which is a massive safety improvement for not only the plant, but the community. These are mustard gas cylinders that utilities are using to put chlorine in water with.
Don't want them.
We're trying to combine, safety, reliability, improved water quality, and cost for rates all into one solution. And that, again, the utilities are really open and the engineers are really open to these types of ideas when you bring it back to those points.
How do you think about the public narrative? So it seems to me like there are a sort of bunch of things working in concert, which we sort of think about a lot. There's about 100 billion of public support, so federal support coming into water for the first time in about 40 odd years, i.e. a big jump in that number, even though there are big asterisks next to it. The recent announcement by Biden about getting the lead pipes out of the system. There is obviously what's going to be coming up with PFAS in the EPA. But I think probably the most important one to me is, and you may have a point of view on this because you have a place in California and spend a good amount of time there. There is an uncovering of the building blocks of water. So the recent New York Times article was on something that we just take as read because we've been doing this for some time, you much longer than I. But the idea that California's system of water rights is based on exactly what happened in 1848, right? And the gold rush, which seems like an odd way to distribute such a vast resource. But these stories are being told at scale in a way that really they haven't been before. And something like PFAS has, entered the public consciousness in a way that other water things haven't before, other than Flint or whatever, which never really got fixed in the end. Like, how do you see that playing out? Are you optimistic in terms of the generalized tailwinds? Do you think I'm overstating the case, understating the case? How would you reflect on it?
I think we have a strong this is part of the tailwind. I think the bigger impact is being able to recover costs through rates. I think that is always the number one source of capital for our industry, is that we have to properly price water. However, there are a lot of very large water infrastructure projects which need to be amortized across very large rate bases, millions of people, populations, which means, federal, state, tax type revenue streams are going to have to be part of the solution. And I would just offer that, I would like to see those sources of money on major infrastructure that cannot be done by individual utilities or communities, as opposed to subsidizing the fixing of Jackson, Mississippi, which is where some $680 million of federal money is going to one of the worst run utilities in the country that we don't even know if it can sustain itself on rates because they haven't been able to bill customers properly for years. I'd like to see that money go to infrastructure projects, not just freebies for poorly run utilities. I think those utilities have an onus to fix themselves. Those communities have to bootstrap them and fix it and get their rates up. And, they got to do all this stuff we've done in all these other communities. So I just think where it's going is my only complaint. But I think it's an important tailwind. We definitely have still a huge amount of infrastructure funds working its way through the economy. We still have rates funding most projects. there appears to be more room and ability for us to manage rates through the next cycle. And then you have this awareness that communities all of a sudden have to the fragility of our water and wastewater infrastructure that you're referring to, and the New York Times is referring to, which all of a sudden they're asking questions. But at the end of the day, Tom, they don't care. I mean, people don't wake up in the morning and think about water while they're taking a shower. Actually, they're thinking about something else. They're either singing a song, or they're thinking about their work day, or they're thinking about all this stuff.
Guilty.
They are not thinking about the water that's pouring on their head. You know what I mean? And so we have to just deliver our industry at the end of the day based on quietly boring fundamentals. And every now and then we're going to have these public outcries and these hailstorms that focus on us. But usually that's because we failed at our basic job. We operate utilities in the public trust. They trust us so much they don't worry about us. And the only time it becomes headline news is when we fail in that trust. And everybody focuses on us and is angry because they didn't know they had to worry about their shower water. Now they do, and they're angry. We want to keep it boring. I hate to say it. We want it to do our job well and keep it boring and keep this trust growing over time so it becomes less and less of a hot topic.
Yeah,
that's
no, absolutely.
Looks like, in 10 more years.
Because underneath it is the churning world of upgrading and doing more with less and these radical increases in productivity. I just want to spend the last couple of minutes before our traditional closing question, if you can say traditional after not that many episodes, but we're getting there, getting towards a tradition.
Creating tradition.
Yeah, exactly. We've spent a decent amount of time talking about hiring and managing teams. Like, what do you think that entrepreneurs should be thinking about, not only during the hiring process, but also managing teams when you're there? I mean, even just down to the kind of nuts and bolts of where you meet and when and what you talk about. Is there anything you can say about that?
First of all, teams are virtual now. This is a skill that I'm still working on. My corporate team is 100% virtual. We have no corporate office because, again, how do you go to that customer and explain your corporate office? What value does that have? None. So we don't have a corporate office. So all of our facilities are dedicated to creating value in our products and services. And then we work virtually otherwise. But building a team in a virtual environment is a new skill that a leader has to have. And we have a pattern where our leadership team has a morning huddle every day for minutes. It's like your family if you have lots of kids, how in the morning before school, the toast is in the toaster, someone's eating Captain Crunch, the coffee's going, you're all packing your briefcases and lunches. But who's going to get the kids after school? Who's going to the PTA meeting? Who's got sports? All that information is exchanged in a precious 5 minutes every morning in a family. We try and create that with our virtual team every morning by having a quick huddle in the morning and then a regular cadence of setting priorities and reviewing them as a team. We set the priorities quarterly and we meet weekly in order to make sure all those priorities are on track and moving along. So we just came up with a pattern, and I'm happy if anyone wants to reach out to me to talk more about that. It's a big topic, but you have to have a solution for how to build your team to get the best people today. The team's going to be virtual. You don't want to spend your precious VC dollars moving people around and buying houses and stuff like that. So you want to solve for this. It's really, really an important skill.
Absolutely. To take us to the end, and I really appreciate this. Thank you. It's been really instructive, even though you and I have spent a lot of time together. If you were to choose one piece of advice to pass on to future and aspiring water entrepreneurs, what would it be?
I think you told me you were going to ask me that. I'm not sure I wrote down any really thoughtful, perfect answer.
The instinctual is often the correct one.
No, so if I were to give, one piece of advice, it really is to make sure you know how to go get sales going in your business. That it's just hard to appreciate how difficult it is to grow sales in our industry till you've done it a few times. And if I spend time commenting on plans that I see, most of it is around, is the path to market really going to move that quickly? Do you fully understand it? Do you have the right people? Do you understand how to price? Do you understand how this impacts rates for your customer? These types of things. You know what I mean? So really this front end, is really always number one for me.
The reason why you know that sales is the most important thing in a business is because it is the thing that is least taught at business school.
Yeah, that's right. Nobody teaches you how to sell to the water industry.
No one's
anywhere. You just have to hope somebody old like me will help teach you it if you're young and ambitious.
Spotted a gap in the market. Let's go.
Right.
It's on. My colleague, Christine Boyle, has written on our blog for those listening. There's a really great article called Why Deep Pain Leads to Great Products, which covers a lot of this, founder-led sales at the beginning and the determinants of being able to do that well. I encourage you to go and see that. But I think it's absolutely correct. The revenue doesn't happen without sales, and the business doesn't happen without the revenue. What could be more important?
Everything follows it.
Everything follows it.
If you have the backlog and the revenues, you'll get as much financing as you need in our industry. There's plenty of money.
Exactly.
You just need to have the revenue and the backlog.
That's a really great place to finish. David, thank you so much for spending this time with us on The Fundamental Molecule. Always a pleasure, and I will speak to you soon.
Yeah, thanks, Tom. That was fun.
Cheers.
Have a good day.